Today, one of the biggest hidden shifts inside the U.S. economy is happening in the housing market. Mortgage rates have now moved close to 6%, the lowest level seen in nearly 3 years. And this matters far more than most people realize. Housing is not just about buying homes, it is a fundamental pillar of the entire economic structure. Let's look at the trajectory. Back in 2023, rates hit a peak of 7.8%, creating one of the toughest markets for buyers in decades. By mid-2024, we saw the first signs of relief as rates dipped to 7.2%, signaling a shift in market sentiment. The decline continued through late 2025, finally hitting the 6% mark this February. This trend is reviving interest across the sector. Housing drives construction jobs, banking activity, consumer spending, and even furniture and automobile demand. It is a massive multiplier. When builders are active, they hire more workers and buy more materials, pumping billions of dollars back into local economies. Similarly, increased mortgage activity strengthens the financial sector, providing the liquidity needed for other types of consumer loans. New homeowners spend significantly on furnishing their spaces, which directly supports the retail and manufacturing industries. When borrowing becomes cheaper, buyers slowly return to the market. But here's the important detail. Rates are falling before the Federal Reserve has officially started cutting. Markets are already betting that rate cuts are coming. They are pricing in future policy shifts months before they actually occur. This forward-looking behavior by investors is a classic signal that the market expects a more favorable borrowing environment soon. This creates opportunity, but also risk. If inflation surprises again, rates could quickly move higher, reversing these recent gains. Economic indicators remain volatile. A single bad inflation report could spook the bond market and send mortgage rates climbing once more. So right now, the U.S. housing sector is entering a transition phase. Not a boom, not a crash, but stabilization. This is a delicate balancing act. Smart investors and buyers are watching this moment very carefully. The window for favorable rates could be narrow. Because historically, housing recovery often signals the next phase of economic expansion. It is often the first sector to lead us out of stagnation. Right now, the Federal Reserve faces one of the most complicated policy decisions since the pandemic recovery. The eyes of the global financial community are fixed on Washington. Every signal, every word from the Fed is scrutinized for clues about the future of the American economy and the trajectory of global markets. Inflation has slowed compared to previous years, but it remains above the Federal Reserve's long-term target of 2%, creating a persistent challenge for Chair Jerome Powell. While we have seen a significant cooling in headline numbers, core inflation, which excludes volatile food and energy, remains stubbornly sticky in several key sectors. This has sparked a heated debate. Some policymakers believe interest rate cuts may begin later this year as they see the economy cooling enough to warrant relief. The Fed is effectively walking a tightrope, trying to balance the risk of reigniting inflation against the growing danger of pushing the economy into a recession. Others remain cautious, warning that easing policy too soon could restart inflation pressures, forcing the Fed to reverse course and hike rates even higher. They are mindful of the lessons of the 1970s, where premature easing led to a second wave of price increases that took a decade to resolve. This disagreement inside the Federal Reserve is creating uncertainty across global markets as investors struggle to price in a definitive timeline for policy shifts. Stocks react instantly to policy expectations, while bond markets continuously adjust to future rate predictions with every new piece of economic data. We've seen significant volatility in Treasury yields, reflecting the market's evolving consensus on how long the Fed will maintain its higher-for-longer stance. And here is why this matters to you. Every decision made by the Federal Reserve directly influences borrowing costs for everything from credit cards to car loans. In the housing market, mortgage rates remain at decade highs, cooling housing activity and impacting business investment and consumer confidence. Corporations are also feeling the squeeze as the cost of capital rises, forcing many to rethink their expansion plans and hiring strategies for the coming years. This pullback in business spending is exactly what the Fed intends to see to cool the economy, but the margin for error is razor thin. If you are watching economic trends closely, this moment could determine the next major direction of the U.S. economy for the rest of the decade. Looking further ahead, current projections suggest a more aggressive easing cycle in the coming years, with up to 4 rate cuts expected by 2026. Investors are no longer asking whether rates will change. They are now focused on the magnitude and the speed of the upcoming shift. The U.S. labor market still appears strong on the surface, with unemployment remaining historically low and job creation continuing across several sectors. However, early warning signals are beginning to emerge. Weekly jobless claims have gradually moved higher, suggesting businesses are becoming more cautious. This trend indicates that companies are shifting from aggressive expansion toward a focused strategy of efficiency and cost control. At the same time, artificial intelligence and automation are rapidly changing workforce dynamics as companies invest in productivity tech. Businesses are now prioritizing productivity technologies rather than expanding payrolls, a transition that could quietly reshape employment for years. Understanding these shifts is critical because employment strength has been the foundation supporting U.S. economic resilience. If hiring momentum slows further, market expectations could change very quickly. Staying informed is the key to navigating this change. We will continue to track these labor shifts and their impact. Stay tuned for further insights into the evolving U.S. economy. Looking ahead, global economic institutions expect the United States economy to remain resilient throughout 2026. This resilience is anchored by several key pillars. While the global landscape remains complex, the U.S. continues to act as a primary stabilizer for the international financial system. Consumer spending continues to support growth. Household balance sheets, while stretched, have proven more durable than many analysts initially predicted. This steady demand is fueled by a robust labor market and consistent wage gains, which are helping to offset higher borrowing costs for many families. Financial markets remain sensitive but stable. Investors have largely priced in the current rate environment, leading to reduced volatility in major indices. While sensitivity to central bank messaging remains high, the underlying stability of the corporate sector has provided a floor for market valuations. And economic expansion has slowed into a more sustainable phase. This moderation is actually seen as a positive signal for long-term health. Moving away from the overheating of previous years, the current pace allows for infrastructure and productivity to catch up with demand. But stability does not mean certainty. There are significant headwinds that we must monitor closely as the year progresses. Rising government debt, evolving trade policies, and persistent inflation risks continue to challenge long-term growth expectations across the board. Inflation persistence remains a primary concern for the Federal Reserve, potentially keeping interest rates restrictive for an extended period. Evolving trade policies are also creating a landscape of uncertainty as international agreements are renegotiated and supply chains are restructured. These global trade pressures can lead to localized supply shocks, further complicating the inflation outlook for essential goods and manufacturing. Furthermore, the sheer scale of government debt is becoming a central theme in fiscal debates, raising questions about future investment capacity. Long-term growth expectations are being adjusted to account for the servicing costs of this debt, which may limit the government's ability to respond to future crises. The U.S. economy today is not entering recession. Despite the cautious tone of some indicators, the overall momentum remains positive. But it is transitioning into a new economic cycle, one that is driven by digital transformation and increased industrial efficiency. In this new cycle, productivity gains from artificial intelligence and automation are expected to be the primary drivers of corporate earnings. Periods like this often create both uncertainty and opportunity at the same time. The key is knowing where to look for the signals. Those who understand economic signals early are usually better prepared for market shifts ahead. It's about anticipation rather than reaction. Being prepared means having a clear perspective on the data and ignoring the daily noise that often obscures the broader long-term trends. And if you want clear, simplified explanations of U.S. economic trends without the noise, make sure to follow and subscribe for consistent updates on the forces shaping the global economy. Because the next major economic move is already beginning to form. Stay ahead of the curve.